Hey everybody, Joe here from Avalon Accounting, and today we're talking about shares and share structure for corporations. So often we do get asked about share structures when people are incorporating their new business, but even more often we get asked about what went wrong with their share structure and trying to fix that share structure later. I'm hoping that you're pre-incorporation, but if you're not and you've incorporated, that's okay. You can go to a lawyer and get things redone, but we'll give you some common share structures that we see, both good and bad, and what we often recommend, especially in a scenario where you have multiple owners. So we'll get into all the details around what different aspects to shares there are and some of the considerations around accounting. We won't get into too much legal stuff, so I'll try to keep it nice and accountant-y for you, but all that and nothing else coming right up. All right, so I'd like to start at the start, and that is, what is a share of a company? So a share is exactly how it sounds. It's the share of a company. If there are 100 shares of a company and you own one share, you have 1 out of 100 or 1% share of the company. So it really depends on how many shares there are and how much you own, but it's simple calculation from there on the percentage that you own of the company. But we will get into how that is made more complex by different share classes and some of the attributes that come with each share class. So we'll get into all of that next. All right, so I'll get into that there can be different share classes. So you can have within your corporation a number of different share classes. Not all the shares are issued at all times, but you may have in your incorporation articles that you can have a number of different share classes with different attributes for each. So you'd see Class A's that might be one set of characteristics, Class B's, Class C's, Class D's, Class E's, and so on and so forth, all the way through the alphabet and beyond. That just means that there's going to be, it's not a simple calculation of one share class and how many shares are owned in it. You're going to have to do some more thinking around how each share class makes up a total number of shares. But we'll get into that. Don't worry about that too much yet. Just good to know that there are multiple classes of shares. All right, so next we'll get into the characteristics of a share class. So you may have Class A's and they may have voting rights attached to them. So you may have Class A's with voting rights, but Class B's that are non-voting. So all that means is that who has a say in the decision making. And essentially this means who gets to vote members to the board of directors that can actually enact decisions on behalf of the company. So that's kind of where that comes from, voting versus non-voting. And each share class may either have voting rights attached to it or non-voting characteristics attached to that share class. All right, so the second characteristic that I'll go through is participating versus non-participating. And this is an accountant's where we play a lot in, is because participating versus non-participating means whether these share classes can take dividends or they cannot take dividends. So you may have a Class A share, and as we're sort of building up, Class A shares of voting, non-participating shares, those are two characteristics of that share class. It can't take any dividends. So you cannot issue dividends to that Class A. Then you may have Class B's that are non-voting, no votes attached to them, but they're participating shares, which means we can issue dividends to this class. And that's a really important characteristic to understand when you are incorporating your business and you're creating these share classes with different characteristics. So next up is common versus preferred. So common shares are what you typically see, what we've been talking about so far, the voting, maybe voting participating shares. If you just had one share class, those would be common shares. Preferreds generally would have a value attached to them that they could be redeemable for, or there's some aspect to a fixed either dividend that they get. But the idea around a preferred share is that they are a preferred class above the common shares in the event of a dividend payment. So they get paid dividends before common shares, for example, or on the windup of a company. If all the assets are sold, all the liabilities are settled, preferreds would come next and common shares would be the last. What's advantage of common shares is they tend to be the most appreciable part of the company. So if you own common shares, most of the increase in value will go to common shares, whereas preferreds might have a fixed value that's either redeemable or they can be retracted or something like that. So it's just good to know. It's kind of beyond the scope of this video going into details on that, but just knowing that there are common and preferred, and they have slightly different characteristics there as well. The next thing you need to understand is about authorized versus issued shares. So when we talk about authorized versus issued, authorized would be how many shares in the articles of incorporation are there to be issued sometime in the future. They may not all be issued, but they are authorized. So you may have, issued 100 shares of Class A's, but you've authorized 1,000 to be issued, and you may sell more of that class of share later to an incoming investor and send those right from the company. So they're newly issued shares, but they've been authorized in the articles of incorporation. So that's just good to know for a number of reasons. Number one, when you're purchasing shares, it is good to know whether you can be diluted. And what diluted means is that, you buy 100 shares of this company, but do you have any understanding of how many authorized shares there are to be issued later? And you can think back to the movie The Social Network. What happened to one of the shareholders early on is that he got, 1 billion shares or something, and he was, excited about that, but he found out later that there was an unlimited number of shares that were authorized to be issued, and he got diluted to something like some really low percentage of the company later because the company issued a lot more shares. So his percentage ownership went way down just because of how many shares were issued later. So just something to understand there about authorized versus issued, and a good scenario to avoid is the Social Network scenario that I just mentioned. All right, so what does share structure actually mean for your business? So there's two aspects that we like to cover here. And number one is, it always comes first, is the legal aspect. So you need to know kind of the legal background of what share structure you need and require for the type of business that you are. And it is good to have a full understanding of the legal implications of your share structure. What we're talking about here in this video is really more around the accounting and tax structure and how different share class structures would affect how you can pay dividends, for example, and what some of the tax implications of those might be. So from an accounting and tax perspective, the share structure really does come into effect when we're looking to pay dividends. Because of the characteristics of each share class that we have, we are able or not able to pay dividends based on that share structure. So what we end up seeing is we'd like to really set up early on, when a business is just incorporating, a structure that's going to allow flexibility in timing and amount of dividend payments to the different shareholders according to the scenarios that they may see come up. And what's really critical to understand here is that dividends are paid to share classes, not to individual shareholders. So if you have Class A's that are 50-50 owned by two owners, and you issue a dividend of, say, $1,000, then that class will take the $1,000, and each owner, 50-50, will have to take $500. They're forced into that dividend taking based on the dividend that was issued to the class of shares. So that'll become a little more clear in the scenarios that I'm about to do, but just really good to know when you're going to set up your share structure that dividends are paid to dividend classes, not to individual shareholders. All right, so let's go through 3 common share structure scenarios, and you can build on these. I think each one of these kind of builds on each other, and you can kind of see from these different share structures, common share structures, where you might fit and where you might be able to adapt if you have a little more complexity in your ownership. So number one is the 100% owner Always will be. So in this scenario, we have a simple ownership structure, 100%, and it's always going to be that way likely, unless they sell the company, but it's usually going to be just them. We can go with a simple share structure in this scenario. So 100% owner takes maybe 100% Class A's, and the characteristics we would want with these one class of shares, Class A's, are voting and participating shares. That's just a straight up way to do it if you don't foresee any future scenario where you're going to take on another business owner, another shareholder within the corporation. One thing of note for this, though, is that we used to always include a spouse in this when we could, because we were allowed to split income with dividends. So we would have a spouse have a separate class of shares, issue those dividends once in a while if it made overall tax sense for the family. But recent rules have sort of clamped down on that tax planning opportunity by requiring the spouse to be either active in the corporation, so working more than 20 hours per week in the company, or they have significant investment in the company. So they've put up the funds to get this business started and have really an investment role in the company. So we don't typically see those two scenarios very often, although it does come up and is something we definitely want to talk about before incorporation. But the typical scenario where we would give a spouse some dividend shares is sort of clamped down on by the tax on split income rules that came in 2019, 2018, something like that, that limits us to be able to do that these days. So how we typically pay dividends in this scenario is that the business owner maybe takes draws throughout the year, they take out some money, but they're also putting some money back into the company when it's needed. So we take the net amount of withdrawals for the year, and then that becomes the dividend for the owner. Nice and simple structure. You kind of get paid, you get your income is based on what you've taken out of the company throughout the year, and we can treat those as dividends and just do that tally at year end. But one thing to note in this scenario is that very little tax has been paid. The corporation has paid some tax on this money, but you're going to have to pay the excess in personal taxes at come tax season. So just something to keep in mind when you are withdrawing money without paying withholding tax through wages, that you are going to have to pay some tax on these dividends that you've taken out. All right, so scenario number two is the classic multiple owner pitfall. And we see this quite a bit, and I'll go through sort of a 50-50 scenario where you have two owners that own 50-50 in the company. And what they do a lot of times is have that same share structure that we went through in scenario one class A's of voting participating shares that each owner owns 50% in. Maybe there's 100 shares and they each own 50. And this is a pitfall because it has completely limited our tax planning opportunities. Because what happens here is, because all the votes and all the dividend amounts have to be locked into one share class, when we do issue some dividends to one of the owners, both owners are forced to take those dividends. So because maybe it's $1,000 of dividends that we want to get into owner number one's hands, we have to issue a dividend for $2,000 to the Class A's, and the second owner is forced to take that $1,000 dividend as well. And so this is a problem because often what we see for tax planning is that, number one, owners don't always have the same, even though they have the same ownership, they may not have the same level of involvement in that profit, so may not want to take the same amount of dividends. Maybe they are splitting their dividends a little bit differently based on different performance indicators or something like that. But you also may have this scenario where an owner has a lot of income in one year. Maybe they sold a piece of property and are in a high tax bracket, and they say, yeah, I want my dividend, but I don't want my dividend until next year, or I'm going to be taxed to the nose because my marginal tax rate is so high this year. And the other owner is saying, well, I need to put down payment on a house right now, and my income's been low this year, so I want that dividend. We're not able in this scenario to really plan around those two things that are happening, and one owner is going to win out and one owner is going to lose in this scenario, or we're going to be forced into doing bonuses, which it can work, but can be a little bit of an issue for some owners when they're trying to plan, and it's, maybe we're doing it in January or something like that. They need to take this bonus earlier. All right, so scenario number 3 is our preferred method when you have multiple owners on share classes. So we'll take the same scenario, those two 50-50 owners, and you can expand this example to as many owners as you like, and I'll show you how to do that. Essentially, what we're going to do is set up a new structure where we have flexibility in paying the dividends, but we also have voting sort of carved out, and whoever is controlling the company carved out into one share class. So what we would want to see in this scenario is a Class A share with voting, non-participating characteristics. So we keep the votes contained into our Class A's, and we may have that 50-50 structure where they're 50-50, or maybe someone's 51 and someone's 49. That's all cool. Then what we're going to do is create some Class B's that are non-voting and participating shares that can take dividends but have no votes attached to them. And we're going to have owner number 1 own 100% of those. And then we're going to have Class C's. Again, we're going to have owner number 2 own 100% of those, and that's their dividend class of shares. So what we can do with the votes is assign sort of dividends between those two different classes. And as you have multiple owners, you could create further and further classes of shares that can take these dividends, and you can do a lot of tax planning around that. It will break down as you get more and more owners, but for the typical sort of maybe 2 to 5 owner sort of structure, this works really well and can allow for a lot of tax planning. So now what we see is that, owner number 1, they sold some property this year. They have a high marginal tax rate. They do not want to take a dividend this year, but they want equality over time in dividends with their second owner. So we will issue a dividend to owner number 2 on their Class C's, and they can make their down payment on the house and take advantage of their low tax rate because their other income has been lower this year. And we're going to wait till next year to issue a dividend to the Class B's because of that high tax rate in that particular tax year. So now we've got that flexibility, and we can pay those two owners at different times. So that's the classic example, the structure that we like to see. And if you are incorporating yourself, we do have a link to a program called Owner. So you can go online, incorporate yourself, use this sort of structure, make sure you have the legal side sort of taken care of, although they do help with that. And you get a bit of a discount using our link, and it really helps out this channel. But overall, I just want to say really a big thank you to everyone who's given us so many positive comments, has encouraged me to start doing some more videos. I really enjoy them, and really appreciate all the positive feedback that we get all the time, which is fantastic. Really, if you have any questions, please post them below. We'll be setting up more Q&A sessions coming up, so we do take a tally of all those questions that you send through, and want to do some more YouTube lives with that as well. So again, thank you so much for watching, and really appreciate the support. And if you want to get notified for all those future things, you know what to do. And if you like this video, you know what to do. Thanks again so much for watching, and hopefully this video has been helpful. Until the next one, see you later.